What if I told you some investors get paid every single month, whether the stock market goes up, down, or doesn't move at all? And no, they're not trading, they're not guessing, they're not glued to charts. They just own the right assets. And here's the uncomfortable part. Most people completely ignore this and end up working years longer than they actually have to. In this video, I'm going to show you how dividend investing actually works, why it matters more than people think, and how it can quietly turn your portfolio into an income machine over time. Let's make this real for a second. You're earning, let's say, $60,000 a year. You're doing the right things, saving, investing, trying to be responsible. But most of your money, it comes in and goes right back out. Now imagine flipping that even slightly. Instead of only working for money, your money starts working for you and actually paying you back. That's what dividends do. They're one of the only ways to generate consistent income from investments without selling anything. Here's a simple scenario. You're 28, you invest $6,000 a year. Let's say you earn about 8% annually. After 10 years, you're sitting on about $90 to $100,000. But here's the part most people overlook. A chunk of that growth didn't come from price increases. It came from the cash being paid to you the entire time and reinvested. Now, fast forward another 10 to 15 years. That same portfolio could realistically be throwing off $3,000, $5,000, even $10,000 per year in income without touching your principal. That's where this gets interesting because at some point it's no longer just investing, it's income. Let's simplify this. When a company makes money, it has two choices: reinvest it or share it with you. A dividend is that second option. It's literally a cash payment for owning a stock. If you own 100 shares of a company paying $1 per share per year, you get $100. No selling, no timing, no guessing. Now, quick but important distinction. Some dividends are taxed at lower rates, whereas others are taxed like income. And this is where strategy matters. Because if you're holding dividend investments inside something like a Roth IRA, that income can grow completely tax free. That's a big deal. Now let's talk yield. If a $50 stock pays $2 per year, that's a 4% yield. Sounds great, right? But here's the mistake. People chase high yields, 6%, 8%, even 10%, without asking why. Because sometimes higher yields are equivalent to higher risk. This is the part most people underestimate. A solid, consistent 2 to 4% yield from stable companies that grow their dividends over time, that's where long term wealth is truly built. And if you reinvest those payments, now you're earning dividends on dividends. That's when the snowball starts rolling. So, how do you actually do this? Well, there's two main paths. First, individual stocks. The upside, your income can grow if the company performs well. The downside, one bad year and that dividend can get cut, which means your income drops, and usually the stock price does too. Second, dividend ETFs or funds. This is where things get simpler. Instead of betting on one company, you own dozens, sometimes even hundreds of companies all at once. If one company cuts its dividend, the rest still keep paying. It helps smooth things out. What percentage of your portfolio is actually producing income? If the answer is close to zero, you're relying entirely on price growth. That's fine, but it's incomplete. Even a small shift changes things. Let's say you invest $10,000 in something yielding 3%. That's $300 a year. Not life changing, but stack that over time, $50,000 invested would lead to $1,500 per year. $100,000 invested would lead to $3,000 per year. And $300,000 invested, now you're talking real income. And remember, that's before growth. Now you might be thinking, why not just stick with index funds? Fair question. Index funds give you broad exposure, low fees, and solid long term growth. But here's the trade off: they're built for accumulation, not income. Yes, they pay dividends, but usually around 1 to 2%. Dividend focused investing, that's intentional income. A lot of smart investors do something like 70% growth, which would be index funds, and 30% income, which would be dividend assets. Why? Because growth builds wealth, but income gives you options. And options are what financial freedom actually looks like. Now, here's something a lot of people miss. You don't need to buy property to earn real estate income. That's where REITs come in. These are companies that own things like apartments, hospitals, shopping centers, and by law, they have to pay out about 90% of their profits as dividends, which means they turn rent into income for you. Let's say you invest $50,000 in an REIT yielding 4%. That's about $2,000 per year, or roughly $160 per month. No tenants, no maintenance, no headaches, just income. Now imagine stacking that with stock dividends. This is where things start to feel real, because now your portfolio isn't just growing, it's paying you. Let's be clear, this is not risk-free. Biggest mistake I see? Chasing yield. If something is paying 8 to 10% consistently, you need to ask questions. Because high payouts often come with instability. Second mistake? No diversification. Putting everything into one great dividend stock? That's not a strategy. That's a gamble. Third, never rebalancing. Over time, your portfolio drifts. Some parts grow faster than others. If you don't adjust, you slowly take on more risks than you realize. Simple rule: once a year, rebalance. Trim what's grown too much, add to what's lagging. It forces discipline. Practical moves you can make today. Let's keep this simple. Here's what I'd actually do. First, check your allocation. Do you have any dividend exposure? If not, start small, even 10 to 20%. Second, use tax advantage accounts. If you've got a Roth IRA, that's prime real estate for dividend income. Third, look at your yield. Not just how high it is, but how stable it is too. Fourth, automate your investing. Even an extra $50 to $100 per month matters more than you think. And here's the big one: increase your contributions as your income grows. If you go from 60,000 to 80,000, but your investing stays the same, you're slowing your own momentum. Here's what this really comes down to. Most people focus only on net worth, but eventually what matters more is cash flow, because you can't spend your net worth without selling something. Dividends change that. They let you keep your assets and still get paid. And over time, that turns into something powerful: less pressure, more flexibility, more control over your time. That's the real goal. So if you take anything from this video, start building income, not just growth, even small amounts. Because 10, 15, 20 years from now, those small dividends, they won't feel small at all. If you want more strategies like this, practical, realistic ways to actually build wealth and income, hit subscribe. Because the goal here isn't just to grow your money, it's to make your money start working harder for you. Thanks for watching, and I'll see you in my next video.